All right, thank you very much, Sarah. Welcome to the Halftime Report. I'm Frank calling in for the Judge Scott Wapner. We are continuing to monitor the TikTok CEO on Capitol Hill. We'll bring you any news that comes out of that hearing. We do have Julia Borston standing by. But in the meantime, we got a strong rally on our hands right now. Looking at the numbers, we got the Dow up 1.25%, the S&P up just about 1.5%, the Nasdaq the best performer right now, up 2%. We're also watching the yield on the 10-year, 3.46, about 15 basis points lower than its high from yesterday. We're going to continue to watch that today. Our investment committee is standing by to break down these big moves. Joining us for the hour, Josh Brown, Bryn Talkington, Stephanie Link, and Jason Snipe. And I think we just have to talk about right now the Nasdaq leading this rally right now. Stephanie, what do you make of this after that big sell-off yesterday? Either it was the Jay Powell comments, a lot more people think it was the Janet Yellen comments, but today we're seeing this big rally.
Lower rates. That helps short duration assets. Technology, comm services is 36% of the S&P 500. They have had a rally this year, but they can go a lot higher, and I think that's what's leading us today. But I think the reason that we're rallying is because it appears that we're in the ninth inning of this rate cycle, right? And I think the fact that Powell walked back kind of the comments that he made a month before about, they have to do more rate hikes. Now they may do more rate hikes. So that's the whole theme, I think, of what's happening today. But overall, I thought yesterday, 25 basis points was kind of in line, but all good for some of these big sectors.
I think that ninth inning metaphor is interesting, Jason Snipe, because remember, baseball goes into extra innings all the time, and it can always happen. So what do you make of this rally we're seeing? We're seeing names, predictable names, Microsoft, Apple, Nvidia, Alphabet, leading this rally today.
I think Stephanie makes an excellent point on yields pulling back, and obviously we're in the ninth inning. We're obviously closer to the end than we are the beginning. The Fed has raised 475 basis points in a year. That's a lot, and obviously Powell spoke to that yesterday in terms of what the guidance is going forward, and I think he also spoke to early on in the presser, the banking crisis and what that means. There potentially might be other landmines out there. But the Fed will be data dependent, but we are closer to the end than we are the beginning. Yields have pulled back, and you see the Nasdaq moving.
So, Josh, what do you make of all this? I mean, a lot of people have been going to tech for safety in recent weeks with all this volatility, especially after SVB. Are you a believer in this rally that we're seeing today?
I think it's important that we just be very careful about the definition. When we say people have been hiding out in tech or going to tech or looking to leadership from tech, it's not just tech. It's consumer discretionary names that we used to consider tech, but now they're in a totally different basket. It's also communications. So that would be like, for example, Netflix, Meta. These are not in the tech ETF. They're not in the S&P 500 tech sector. So let's be very clear about what we're actually talking about. We're talking about essentially the 25 or 30 largest non-oil, non-financial companies that have the biggest and best balance sheets, the most cash flow, and the best ability to self-finance if and when, some would say inevitably, credit availability contracts. These are the stocks that people are buying. The Bank of Apple never closes. Nobody has to worry about Microsoft's access to capital or to cash. Nothing tells us that Oracle needs to roll their debt. Like, this is what's really going on right now. It's not tech only. Amazon is in the consumer discretionary sector. Okay? So I think that's the big picture. Now, does it make sense? Well, current odds for the May FOMC meeting, 60% chance of no hike, 40% chance of another 25 basis points. 1 month ago, there was a 72% chance of 25 basis points, and there was even a 30% chance of 50. So the market is getting comfortable with this idea that we're wrapping up here and the Fed is pretty close to where its limit is. Now look at treasuries. There are no treasuries currently yielding more than 5%. You could not have said that even a week ago. The highest rate now is the 6-month, which is 4.8%. The 2-year is back below 4%. That's the lowest in September of 2022. So can growth stocks with great balance sheets and tons of cash flow continue to lead the market in that environment? I think they can. And so I wouldn't expect this type of thing to mean revert anytime soon, which means if you're underweight this area, you've been ignoring these stocks because they didn't work last year, now might be a good time to pivot.